Yo, what's good everybody? Welcome back to another video. So in this lesson, what we're going to cover is pretty much just the anatomy of the candlesticks. And what I mean by the anatomy of the candlesticks is really we're going to be going into entry candlesticks. This is kind of the more exciting part, if that's how you want to put it, about learning how to trade, are the candlestick patterns that we're going to be looking for when we're going to actually enter the market and look to make a profit. So these candlestick patterns are pretty much simply going to be used for our day-to-day trading, and these are going to be our only entry techniques. So we're not going to be using any other entry techniques. And when we see these patterns, we're going to be using a market execution. So in this lesson, we're going to cover candlestick entry patterns, aggressive entries, conservative entries, single formations, and variation patterns. So let's cover some of the more important patterns used for entering the market. Now, you can always backtest these patterns, or you can always make or look for your own entry patterns. These are just the patterns that I found work for me the best because, again, there's always going to be patterns in the market that tend to repeat themselves. And these are the ones that I found that repeat themselves the most. Now let's cover the candlestick for entry patterns. Now, one thing that you have to remember, it's not about the pattern itself, but where the pattern is forming or has formed. So we're only going to be looking to enter or look for these patterns at pullbacks in the market or areas of support and resistance. If you see one of these patterns just randomly happen, that doesn't mean you should enter the market. You should only look for these patterns at areas of support and resistance for the highest probability trade. Now, there are two approaches we can take: the aggressive and the conservative entry formation. Depending on what type of personality you are, and again, it just depends on a lot of things, right? But really, it comes down to your personality. Are you somebody who wants to be more conservative, or are you somebody who is a little bit more aggressive, right? Now, conservative entries and aggressive entries have their pros and cons, which we'll go over in a second. But when it comes down to both of them, you're just going to kind of weigh out the pros and cons of both. For example, waiting for a conservative entry is going to decrease your risk to reward ratio, meaning your stop loss is going to be a little bit bigger and your take profit is going to end up being a little bit smaller because you're using a stop loss, right? And that's just simply because you're waiting for the market to go in your direction a certain amount before you actually enter the market. Now, with that being said, you're most likely going to win more trades with a conservative entry because you're waiting for the market to give you that confirmation that you're looking for. Now, the pros and cons of an aggressive entry is fairly simple. It's kind of the opposite. So you're actually going to have a smaller stop loss with an increased reward, right? But at the same time, you're going to lose more trades because you're not waiting for the market to give you that stronger confirmation. Now, there's obviously a higher probability aggressive entry that you could wait for, where you could only take aggressive entries there. I take both conservative and aggressive entries. It just really depends on the situation of that trade. Now, our conservative entry number one is going to probably be one of my favorite entries, which is going to be the bullish engulfing candlestick, right? So in this situation, if we look at the bullish or the bearish engulfing, right, notice how this candlestick closed above the open of the previous candlestick, right? That's going to be considered an engulfing candlestick, right? Look at this candlestick here too. Notice how this candlestick closed above the opening of the previous candlestick. That's also going to be considered a bullish engulfing. And again, we're only going to look for these entries at areas of support and at areas of resistance, right? So for example, at areas of resistance, we will look for the bearish engulfing. Notice how the actual bearish candlestick closed under the opening of the bullish candlestick. That's going to be considered an engulfing. is when the candlestick closes above the opening of the previous candlestick. That is how you can identify a bullish or bearish engulfing, right? Now look at here. Here you have a bullish or a bearish engulfing. Here you have a bullish engulfing, right? Does that mean that those entry candlesticks are going to be the highest probability? No, we'll get into that later on. We'll get into a medium and a higher probability engulfing candlestick, which you can determine your risk based off of that. But as of right now, this is a bullish engulfing candlestick because the close of the bullish candlestick closed above the open of the bearish candlestick. A bullish candlestick is simply just going to consist of one candlestick where it simply just closes above the previous bearish candle, and the bearish candlestick is going to be the opposite of the bullish candlestick. It's simply just a bearish engulfing where the bearish candlestick closes under the open of the previous candlestick. So this is the first pattern, and again we're going to look for more examples in part 2 of this video, but I want you guys to get the overall concept first. One thing that you could do is print this sheet out, maybe go find an example online, print it out, and put it on a sticky note right in front of your computer, so you could just, as you're trading, this is my entry candlestick. I will only look for these candlesticks at areas of support and at areas of resistance. So that's the first entry method. It is a conservative entry. Now here's the second conservative entry. It is a bullish variation pattern. Now typically a bullish variation pattern is going to consist of 2 to 3 to possibly even 4 candlesticks. We'll get into that later on. But notice how the variation candlestick, what we're looking for in the variation candlestick is to see if price can close above the open of the previous candlestick itself, right? So we have the first bullish candlestick here. My apologies, if price could close above the previous close of the previous candlestick. So here we have a bullish variation pattern here, and then here we also have a 3 variation pattern form, right? It's going to consist of 2 candlesticks. So notice how this candlestick closed above the open of the previous bearish candlestick, right? That's going to be considered a variation. That's a high probability variation. And then here we have another high probability bullish variation pattern here, where it closed above the open of the previous candlestick. Now I wanted to put this example here because this is an example of a bearish variation, but it's an example of a low probability bearish variation because it was not able to close under the low of or the open of the bullish candlestick. For it to be a true variation, it needs to close under the low of the bullish candlestick itself. Just like you see this bullish variation close above the open of the bearish candle, along with this bullish variation pattern here, this one did not. I didn't want to include that there, but this is also what a bearish variation typically looks like. It's the opposite of the bullish variation. And again, the variation pattern will consist of 2 candlesticks. Now, when it comes down to another, this could also be considered a variation pattern if you'd like it to, but this is going to be a 3-bar reversal. So notice with the bullish variation, there's 2 or 3 bullish candlesticks, but with the bullish variation here, it's only 1 bullish candlestick, right? So you can consider the 3-bar reversal again. These are all conservative entries, right? The 3-bar reversal could be similar to the bearish variation or the bullish variation, except the difference is it's going to be 1 bullish candle or 1 bearish candle, right? And it's going to be 2 candlesticks that move in the opposite direction. And if we take a look at this bearish variation, typically a 3-bar reversal is going to consist of a high momentum candlestick such as this one, followed up by a low bullish momentum candlestick, then a big strong engulfing bearish candlestick. Notice the variation pattern, right? You actually have a single bullish candle versus here you have 2 bearish, right? Here it's literally the opposite. You have 2 bullish, 1 bearish, right? And then look at the bullish example. You have 2 bearish, 1 bullish. Look at the bullish example here. You have 1 bullish, 2 or 3 bearish, right? And we call this a 3-bar reversal because again, it only uses 3 bars. Now let's look at the bullish things. We have a high volume candle followed up by a low volume candle followed up by a high volume candle in the opposite direction. So again, we have a high volume, high momentum candle, followed up by a low volume, low momentum candle, followed up by a big volume, high momentum candle in the opposite direction, right? Now, we'll be looking again for these patterns at areas of support or areas of resistance to take a trade, nowhere else. These are going to be providing us the best trade opportunities, these candlestick patterns. Now let's take a look at some aggressive entry candlesticks, right? Again, we'll go over more of these entry candlesticks in detail in the next video, but here we have a level of resistance, as you guys could clearly see, right? Level of supply and demand, right? An aggressive entry would be pretty much taking a trade based off the first rejection of this area. So you would typically enter right off of this initial candlestick closure, because notice how it failed to close above resistance. Right once it closed back under and it closed with low momentum, it's going to be an entry candlestick. So typically an aggressive entry candlestick would be a candlestick that's low momentum, right? Now, what I mean by that doesn't mean that it's going to be a low momentum. So in this situation, we'd be looking to sell. We'd be looking for a low momentum bullish candlestick or a very weak bullish candlestick to actually take the sell. So if you would have sold right here, it would have worked out perfectly. Zero drawdown, small stop loss, big target, right? So again, notice resistance, and then notice the rejection of resistance and the loss of bullish momentum, making it a very weak bullish candlestick. In that situation, that's where you would take your sell, because it shows us rejection. This shows us that sellers are in the market. Now, this is another example, right? Same concept. Notice resistance, and then the rejection and loss of bullish momentum with this bullish candlestick here. You would sell right then and there when this candlestick closes for an aggressive entry, and then notice price kind of consolidate and then continue to go down and short, right? Those are two examples of an aggressive entry. You can even look at here for an aggressive entry as well. This is a high momentum candle, which you would not. So the concept is fairly similar, but in this situation, you would actually take the short after this bearish candlestick. Pretty much, it's going to be an aggressive entry candle is pretty much going to be the very first candle that rejects a level of support or a level of resistance. That's going to be your aggressive entry candle. Now, this is the last form of the aggressive entry candle, which is going to be considered the pin bar. You can think about a pin bar as almost like a hammer, right? Where it's a very strong candlestick, but it doesn't have a lot of volume. It's kind of like it's basically what it shows us is a big rejection in the opposite direction. That's what we want to see when we take these aggressive entries, right? So notice here we have a big rejection of resistance, meaning that we're going to have a big bullish wick. And then here, same thing, rejection of resistance, we have a big bullish wick. Those are going to be our aggressive entry candles, right? This is another form of an aggressive entry candles, which is going to be our bullish and our bearish pin bar, right? So this is kind of what they look like. The bullish pin bar, we're going to look to actually buy at levels of support, and the bearish pin bar, we're going to look to sell at levels of resistance. I like to call these the in between the aggressive and the conservative form, because you're buying or selling in the same direction as the candlestick closure, unlike the true aggressive entry where you're buying or selling with the opposite candle, right? Would be selling with a bullish candle and would be buying with a bearish candle, right? So the pin bar is kind of right in the middle here, right? So you'd be looking for these candles at areas of support and resistance. They don't really happen too often from my experience, but when they do happen, I do like to actually trade them and enter the market with them. Now let's cover the probabilities. Each candlestick has its own probability, and it's our job to determine the probability of that candlestick, right? High probability candlesticks. So when it comes down to the probability of the candlesticks in themselves, right? This is mainly going to be for our bullish and our bearish and our variation patterns, which again, we'll go more in detail in the next video. So when we have a high probability candle, it's when the candle closes above the high or the low of the previous candle. So let's take an example of the bearish here, right? This is actually kind of the opposite. So this is supposed to be bearish. This is supposed to be bullish here, right? So with this bearish engulfing, right, notice how price closed under the open of the previous candle. Now notice how the open is also the lowest low here, which is something we learned in the last lesson, right? Once price closes under the lowest low, that's going to be a high probability bearish engulfing, right? Notice price go down immediately right after that. Same thing here, right? Notice how this bearish candle closed under the lowest low of the previous bullish candlestick, making it a high probability entry candlestick. Now, notice how this bullish engulfing closed above the highest high of the previous candlestick. That's going to be the entry candle. That's really what we want to see. When we're looking at an entry candle to actually buy, we're going to be looking to take the trade only after we see price close above the highest high of the previous candlestick, right? Or the high of the candlestick. Basically, it has to close above the wick of the previous candlestick, right? It's as simple as that. A high probability entry is an entry where the candlestick has to close above the wick of the previous candlestick, right? So look at it here, right? Notice how price closed above the wick of the previous candlestick here. And notice how price also closed above the wick of this previous candlestick here. These are all going to be high probability entry candlesticks. So one more time, notice how price closed under the lowest low of this candlestick here. There's no wick, but it's still the lowest low. And notice how price closed under the lowest low of the previous candlestick here, giving you two nice sell signals that are high probability. But now, remember, it's not about the what, but about the where. We're still only looking for these patterns at areas of support and at areas of resistance. Now, let's cover what the medium probability candlesticks look like. Pretty much, they're still engulfing candlesticks, right? They're still engulfing or variation candlesticks, but they don't close above the low or the high of the previous candlestick, right? So notice this bullish engulfing here. Notice how it didn't close above the highest high here. It's still a bullish engulfing, but it's a medium probability, right? It's not a high probability. If it would have closed above the highest high here, being the wick of the previous candlestick, then it would be a high probability candle. Right now, notice here, notice how it failed to close above the highest high, right? Making it a medium probability, right? A medium probability is simply when the candle engulfs, but doesn't close above the low or the high of the previous candlestick. Again, look at the bearish example here, right? Notice how this candlestick did not close under the lowest low of the previous candlestick. That's going to be considered a medium probability. Same thing here. Notice how the candle engulfed but didn't close under the lowest low of the previous candlestick, making it a medium probability candlestick, right? So now we will only be focusing on trading medium and high probability entries. I don't want you guys to take any trades that have a low probability. As simple as that, right? Now, depending on the probability of the entry will determine the risk that's involved. This is for me, right? Typically, when we have a high probability entry, I'll risk 2 to 3% on that trade. When we have a low probability entry, I'll risk anywhere between half to 1.5% on that trade. Risk on my overall account size. As simple as that. We'll get into risk management later on, but I want you guys to put this in your notes now because that's how much I risk per trade. Because everybody asks me, oh, how much do you risk per trade? Well, I mean, it really depends on the trade itself, right? Now, these are just the entries. So we have a high probability entry. We're also going to be going over high probability setups, and we have to tie everything in together. Pretty much is literally all we're going to do. So in the next section, we're going to be going over this more in detail and looking for way more examples. So this is just kind of the beginning of pattern recognition, right? So I really want you guys to go into your charts, look at these examples, and study every one of these patterns so you can start building that pattern recognition. And I'll talk to everybody in the next video.